Tony Sycamore, welcome to the podcast. How's it going today?
Very well, thank you, Etienne, and thank you for having me on the show.
I'm super happy to have you, and we've talked together before a little bit, so I kind of know a little bit what you're doing, but I'm really happy to know more about what you're gonna do and pretty much everything you've been doing in the past also. So the first question we ask the guests usually in the podcast is, what is one quote that inspires you?
I always go back to the Sun Tzu quote. I mean, every battle is won before it's fought, and I think that relates perfectly to trading. Everything we hear talked about, planning a trade, sticking to your plan, not acting impulsively. I think that applies perfectly to trading. There's some other really good quotes out there, and I think for me that's the one which sums up trading the best and the markets as well. I mean, it is a battle out there, and you have to be prepared, and preparation is everything. So that for me is the one which sums up markets the best.
I like that. So tell us a bit what you're doing these days exactly with trading and outside trading, let's say.
Yeah, okay. So I recently started a new venture. The best way of sort of introducing it, the new venture, is by virtue of a little bit of background, what I've done previously. So I came from a trading background. The GFC, I was part of the Goldman Sachs Sydney prop trading team. The GFC, obviously, and the subsequent changes there to the laws, Dodd-Frank, and all that type of stuff. Prop trading was virtually outlawed, as we know. And the bigger guys from Goldman's went off to the hedge funds around the world, the Tudors, the whatever. They've moved on. My P&L, I was probably one of the smaller traders in the room there, and my P&L didn't really warrant one of those big hedge funds taking a close look at me. So I took a little bit of time out of the markets, and I knew that I wanted to get back into markets, and my edge was FX. And when you're in trading, we talk about edges and what your edge is. And for me, I traded a lot of indices, I traded a lot of rates and commodities and gold. I found FX to be the most suitable spot for my skill set. So I started looking into moving into an FX sales role. So I moved into FX sales role around 2010 with BNP Paribas. I spent a couple of years there because of the GFC, which hit the US banks particularly hard. The European crisis came along, which was obviously the credit sovereign issues that the heavily in debt nations were having over there, and France was Italy, Spain, Portugal, they're all at the epicenter of that crisis. And being a French bank wasn't a particularly good place to be at the time. So I upshopped and moved over to CBA. So I spent the last 5 years at CBA doing sales, FX sales. And part of my role there was writing a technical report. So while I was at Goldman's, I was part of a macro team, but every macro team that I've worked with, the traders there rely on technicals to some degree, whether they admit it or not. Every trader I look at is looking at a chart during the day. So I was putting my technical analysis into the meetings, and later took that to BNP where I wrote a report, and then to CBA where I wrote a technical report. And I guess for me, it gave me a bit of an edge. We speak about edge a lot, but it gave me an edge when I was speaking to my clients. And the clients we're talking about were hedge funds, big real money accounts, central banks, corporates, large corporates, and you need an edge, and that was my edge, and it was well respected. We did the report got me over to an awards night in London last year, and towards the end of last year, things started to change with the industry. The industry is going through a lot of change, as you know, but there was a review of how the cover with regards to hedge funds was being handled at CBA. And as part of that, I left CBA at the end of last year. And in the back of my mind, I'd always had an interest in returning to trading, and I always get asked a lot of questions about technical analysis from clients, from friends, from family. So I spun that out into my new venture, which is called TechFX Traders. And TechFX Traders is basically bringing the research to a wider audience that I was presenting and talking to my hedge fund and institutional clients about, my central bank clients about, taking that sort of research through to a broader market. And with that as well, I've also returned to trading just in a PA capacity. So I'm trading my own account, and basically trying to blend those two skill sets together going forward.
That's interesting because your background is really about institution. You've been working a lot for like big banks and even Goldman, which is pretty interesting. I'm curious to know the dynamics. Do you prefer to trade on your own or for like a big institution? What are the differences and the maybe the advantages disadvantages of that?
Look, I think definitely you want to be trading for a big institution. The reason I say that is for reasons explained by human nature. People, I think, feel more comfortable trading other people's money. So the other thing as well is when you're trading an institution's money, you also have a larger pot to trade. So I'm trading what I would call an account that, by comparison to what someone at Goldman's might trade, is very, very small. Um, but yeah, I think, in terms of if you get the option to trade other people's money, you definitely want to give that a go if the option's there. And yeah, I can't, there's different pressures that come with both sorts of trading. With trading an institution's money, you've got basically your risk managers, you've got your trading room managers watching you. At Goldman's, they were very, very good. They basically let you go within the confines. When I say they let you go, they had faith in their traders. They knew their traders had a lot of experience, so they were confident in the trading room's ability. Um, but there was days where the room had big up days, and there was days when the room didn't have such a good day, and that was something which you had to manage because you're answerable to somebody else. When you're trading your own money, the only person I'm answering to at the moment is my wife. So it's a different, as I said, it's a different pressure, and that's, I guess, a rough outline of how that works.
And do you find yourself applying the same methodology, like the same day trading, or is it different?
Yeah, well, it's a good question. The markets have changed a lot, and they're going through another period of change at the moment. But back when we were trading at Goldman's, in a nutshell, we were more day traders, if you like. So we were looking at correlation analysis a lot more closely than we do now. The main reason being was technicals involve correlations. You're looking at things like, in traditional technical sense, I use Elliott wave, I use candlesticks, I use trend lines, support, resistance, Fibonacci's, all those things that you hear and read about on trading websites and blogs. It's just how you put them into your mix. So that was a part of it. But we're also looking at how markets affected FX. Now, FX is a wonderful market to trade because it's very, very, very driven by other asset classes. And when I talk about other asset classes, I'm talking about rate markets, I'm talking about commodity markets, I'm talking about stock indices as well. So a big move in a stock indice, which I think is probably the best way to look at the mood of risk or the mood of markets at that particular time. If equity markets are rallying, we're in a risk on environment, people are generally happier to go into riskier types of currencies. Now, when I talk about riskier types of currencies, it's generally those sorts of countries which have current account deficits. So in the past, that's been places like Australia, New Zealand, Canada. And in risk off mode, you see investors flocking into the safe havens, places like Switzerland and Japan. So we were trading those sorts of risk on, risk off moods very actively. We were trading a macro backdrop as well. So we were looking to see what was happening with things like terms of trade, for instance. So Aussie Kiwi is a cross rate which we look at a lot in our trading sense down here in Australia and New Zealand. Probably the most overtraded cross in the world because it's, I think it takes a lot of the US dollar exposure out of markets, and you can still have a view on Australia and you can still have a view in New Zealand. But the terms of trade, at the moment we're going through a very interesting decline from our terms of trade, which hit an all-time high 2010, 2011. And ever since then, as our iron ore boom and our commodity booms have become more, I guess, export driven rather than labor and the exploratory part of that phase, we're seeing also our commodities are less in vogue now because people are less interested in coal, they're less interested in iron ore. But on the flip side, you've got New Zealand where you've got the terms of trade still doing very well over there because their exports, clean food, clean dairy, the world wants those sorts of products. So you look at how that affects the differentials, firstly on a rate basis, and secondly, how the terms of trade are affecting the currency pairs. So that's something we looked at. But yeah, there was a whole gamut of, I guess, trading strategies which we employed. Some of them don't work anymore. I'll hasten to add that. So what I'm doing now is I found myself going back to leaning more strongly on my technical analysis, looking for entries, exits, resistance, support, those sorts of things, where I see buying interest coming into the market. But I also still use the backdrop, which I learned at Goldman's, because to me, technicals are fantastic. I think you can trade markets based on technicals, but when you marry together technical analysis and a fundamental analysis, I think that gives you a very strong edge. So I don't like doing one without the other. I think both work hand in hand. But a lot of fundamental analysis is also portrayed in charts as well. So I often hear people saying, well, what charts do you look at? And I often, I'd say, well, these are the charts. I look at G10FX, but I also look at the charts underneath the charts. And that to me is a key point of being a successful technical trader. You've got to look at what the terms of trade are doing. You've got to look at what interest rate spreads are doing. You've got to look at what equity markets are doing, what bond markets are doing. So that's how that all wraps together.
Mm-hmm. Do you find yourself applying this more to day trading, or is it swing trading also?
Eddie, and when I was back at Goldman's, we're talking 10 years ago, I was a lot younger than I am now. So the thing about that trading room was we were very active traders over data and around data. And one of the things I still tell my members, which have signed up, I don't like putting trades on before data, because with something like the Australian labour force data, we know there's problems with the sample size. We know there's problems. The ABS have told us they have problems with the sample size. So what edge do I as a trader have trying to analyse that data? So I'd prefer to have a backdrop in my mind going into that data, how the charts look of the Aussie, how the charts look of Aussie Kiwi, Aussie CAD, Aussie Euro, all those type of cross rates. And then when the data comes out, I can react. So I react, but it's more on a longer term basis now. I'm not looking for day trades. Back then at Goldman's, we'd get into those trades and we'd leverage hard into those trades, but we'd be taking profit, because what we'd find is Asia would lead these moves, and then London and the US would take the moves through to the next stage, if you like. And that's where we were taking profit. So effectively, we were fading those moves by that stage, or at least taking profit. But markets have changed, as I said, now. So I'm trying to pick up, as I said, the technical overlay with the macro backdrop. I'm still doing the same thing, but on a longer time scale, because I don't have the wad of cash behind me that I had. B, I'm still trying. I'm not a young man anymore. And when I left Goldman's, by the time I left Goldman's, day trading, when you're up at 6 o'clock in the morning, and then you're not going to bed until midnight after you've watched the US data come out, you put your call levels in, you put your stop levels in, and often you're only getting 2 hours sleep at a time. And as I said, that takes a toll on your health. So I've tried to take a broader time frame to my trading now. So very rarely do I day trade. In fact, it's basically non-existent these days. I'll take trades for 2 days, but more often than not, I mean, I've held a short Aussie CAD position now for a week and a half. I've had long Euro Aussie on now for a week and a half. They're the types of timeframes I'm trying to trade as well. So it's an interesting blend, because I don't want my readers or members getting bored, but also I'm a big believer that it's basically quality over quantity. So I need to find the right mix for what I'm doing now. I still want to put those quality trades on there, but I don't want people to get bored. So that's my challenge at the moment.
And yeah, I feel pretty much the same way, since I travel now and trade pretty high time frame these days. I feel the same way, so it's interesting.
Yeah, it's a young man's game. Day trading is a young man's game, and as I've got 2 young kids now. It's very, you've got to be in front of the screens the whole time. I mean, the big moves happen when you go to the bathroom, or they happen when you go down to, go to the gym or something like that. So it's very, very much, labor intensive. You need to sit in front of those screens, but fortunately the markets have changed, and I think my time frames have changed with that as well, and also with getting a little bit more mature.
Mm-hmm. We'll talk about your trading strategies and what you do these days a little bit more after, but I want to go back in time a little bit and tell us how you started to trade exactly. Like, what's the story behind you getting into trading?
Yeah, good question. So we're going back now over 20 years ago, and there was a period there where I was finishing up my university degree. I was doing a Bachelor of Business, and I was playing rugby down at the local rugby club, and we're into the last few semesters there, and a few of the older players were asking the younger players, what are you going to do when you finish uni? And a few of my mates said, well, I'm off to advertising. A few said, well, I'm going to do architecture. And I'd always wanted to get into the markets. And one of the chaps said, well, listen, we're looking for a trainee on our desk. And it was a trainee role on a bond desk in one of the bond broker firms in Sydney. And I replied, yeah, look, I'm really interested. Can I come in for an interview? They said, sure thing, come in next Wednesday. We'll see you at midday. So I don't even think I had a CV together at that point of time, but I went into the city. I caught the bus into the city and went to the office, and they said, righto, we're going to have our meeting down at the local pub. And I went, oh, okay, all right. And I wasn't, I was very much well into sport and fitness, and I thought, well, okay, let's see, this will be interesting, see how this pans out. So cut a long story short, we went across the road to the local pub and we had, I think, half a dozen beers and a steak. And I think they were quite impressed at that point of time that I was able to still, walk out of the pub in a straight line after 6 beers. And they offered me the job. And I think part of the reason for that was a broking role in those days also involved a lot of entertaining. So I guess they wanted to see what sort of disposition I had with regards to that. And I spent 2 years there on the bond desk. It's actually where I first started getting interested in charting. I was charting by hand the 3-year, 10-year bond spread on the Sydney Futures Exchange. So in those days, we didn't have the technical analysis software or the charting packages that we do have available to us now. So I was putting them all by hand, updating them daily. And I guess that's where I first discovered charts and how I could use charts. Anyway, long story short was I guess I found that role a little bit not, it wasn't exactly where my skill set was. I decided to try and explore other venues, and I moved down to the Sydney Futures Exchange. I had a buddy there which helped me get on the Sydney Futures Exchange as a visitor, and I ended up getting a role there on the futures floor with Macquarie Bank. And that was the futures floor. If you've seen footage of the futures floor, it's a lot of people standing around in trading pits, trading futures contracts in colourful jackets, screaming and yelling at each other. And I think part of the reason why I got a role there was because I'm quite tall. I'm over 6 foot. So it does help to be a taller person in those types of situations where you're all climbing over the top of each other in trading pits and whatnot, particularly over data. It got very boisterous, and sometimes you really had to make yourself seen and heard. So that was my introduction to the futures floor, and I had a great 2 years down there. I loved everything about the futures floor. It was fantastic, the atmosphere, the excitement over data, and to be honest, it was a little bit of a boys' club, which it was it was like going to work with your mates every day, which was fantastic. So that came to an end when I guess part of the process, which we continue to see to this day, the evolution of technology, and the Sydney Futures Exchange went from the open outcry system to a system where futures are now traded on electronic exchanges. So I was a little bit, at that point of time, I was thinking, well, I want to start trying to trade for myself. So I left the futures floor. I left working with Macquarie. I went and started trading my own account. So I had a very small account, and for the first 3 or 4 months, I was absolutely killing it. Like I was just day trading SPY and a little bit of bond futures, and in between trading and whatnot, I was going down to the beach doing surfing, which I love, and I was playing golf and doing all that type of stuff. And I thought, this is fantastic. I've nailed the life here. I think I was probably, we're talking about 1998. So I was 25, 26. And I thought, right, this is it. Next 20 years, this is pretty good. I know where I'm going with this. But what I didn't realize at the time was I knew absolute diddly squat about trading. I'd had a few good months. I thought, right, I'd nailed this. And sure enough, I'd been in a position where I hadn't had my views tested. And my views were tested quite significantly 3 or 4 months later. So I muddled through that sort of next 2 to 3 month period. And then by about 6 months, I'd realized that, hey, listen, Tone, you've given back a lot of cash. You've given back when I talk about a lot of cash, to me, a lot of cash back then, it doesn't sound like a lot of cash now, but you've given back all your profit from your first 3 or 4 months. You need to go back and learn about trading. So from trading my own account, which lasted, I think probably by the end, I'd wrapped it up after 6 to 8 months, I went and worked on a retail futures desk. And that retail futures desk was at a firm called JB Weir. JB Ware, I'm not sure if you've heard of it. It's not around these days, but it was a very old stockbroking firm based in Melbourne. But they also had a private client or a retail futures desk. And I came across who was soon to become one of my trading buddies at Goldman's at that point of time. So he was trading a retail futures fund. Basically, what that means, he was trading, I guess, a pool of clients' money, in a pool of retail clients' money through future strategies. And the future strategies he employed was using optionality and using technical analysis to put on options trades. So my technical, I guess, passion for technical analysis, which I'd first come across back in the much, 4 or 5 years ago back at the bond broking firm, and also down on the Sydney Futures Exchange, I'd used to pick up all the technical reports there, which the bond brokers put out. But all of a sudden, I was able to use that technical analysis to help him trade his account or trade these people's accounts. And these accounts had absolutely gone boom busters. I think if you put a 50 grand deposit with these guys at the start of 1998, it was worth 450,000 by about 2001. So it did very, very well. And it was a short vol strategy, which anyone that knows about options trading can tell you vol strategies, it's like picking up dollar bills in front of a steamroller. Eventually, it's going to get you. So we had a wonderful run there for about 3 years, but then we had a series of events which tested our mettle a little bit. And the first of those was the planes, September 11. We got the phone calls there. Turn on your TV. The brokers calling us up. Turn on your TV. Planes just flown into the World Trade Center. So got up, turned on the screens, and it was basically what we saw happen there in the markets had been, I think, premeditated a little bit by the terrorists. This is all obviously controversial or whatnot, but fortunately, some of our short vol positions, if you look at what happened going into September 11, markets had already started selling off into that period, and we'd been stopped out before that. But what happened after September 11 was a big wake-up call to us. We didn't really want to be selling vols with people flying planes into buildings all of a sudden. So we tried to adapt our strategy. We looked at other product classes, things like natural gas and whatnot. But the returns weren't as good after that September 11 period. We were just trying to, I guess, evolve. We went to try to trade the DAX a little bit more actively, doing things like that. In 2003, JB Ware merged with Goldman Sachs. Now, Goldman Sachs ran their ruler through the entire business, and they didn't like that a couple of guys were trading retail futures money, retail clients' money. Now, Goldman Sachs are very big, or were very big, on trading their own money, but they didn't want any of the reputational risk that might have come from investors losing money, particularly retail investors. So at that point of time, we got swept down into the prop trading room, which for us, it was my buddy, my trading partner, and myself, was absolutely fantastic. He was more senior than I. He was my manager on the desk, but the fact that he took me down there was absolutely fantastic. And all of a sudden, we're in a room, I would say, with probably 15 of the best traders, probably in Australia. So that was the start of things as Goldman Sachs came to be known in Sydney. So there's no real, I guess, you talk about people getting into these trading roles, and for me, it was a very lucky break, I guess. And I don't know how many traders out there at the moment. I've listened to a couple of your podcasts and other stories of traders getting into trading roles, and to me, I hear similar sorts of stories. It's about being in the right place at the right time, and I really was in the right place at the right time. So they basically sat us down and said, listen, no more trading client money. Here's a wad of cash. Go for it, guys. And we sort of looked around, and we're looking at all these successful traders around us, and thought, well, how are we going to make enough money to even be relevant to what's going on elsewhere in the room? And we tried to, I guess, evolve our technique and our strategies, and we were using technicals again. We were trying to do relative value trades on stock indices, DAX versus whatever, CAC, or Nikkei versus the Hang Seng, or SPY versus the S&P, and we had mixed success doing that. My trading buddy at that point of time started to lose, his focus shifted to a different area around 2005. And at that point of time, I became infused with the proper macro traders in the room. And that's to me where my real learning period actually started. To sit down and to talk to these guys was absolutely incredible. And I was preparing, I guess, a little bit for this interview last night. And I've gone through my folder of trading notes, and I'm still pulling out notes which I took, even broker research notes from, I don't know if you can see that, but that's a Deutsche Bank research note from 2008. Bund charts from 2006, 2007. But I've literally got folders and folders of stuff which I just, when I got in that room, you just had to be a sponge because there was so much knowledge in that room and it was such a good opportunity. So I guess that's how I sort of learnt to trade, if you like. I was privileged to be in a very, very, very rarefied environment with some of the best traders in Sydney, probably globally. And I look around at the traders, and there's still guys trading at big funds today and still doing very well. And in my FX sales roles, a lot of those traders became my clients, which I guess was the natural stepping stone once I left trading. So to cut a long story short, things started doing pretty well around that period. Into 2008, I had my best year. I made 25% on my capital, which compared to some of the guys there wasn't that fabulous. But, for me, it was a real sort of breakthrough year. And I thought, well, if I can have a couple more years like this, I'm in a very, very good place. But what happened towards the end of '08, we'd seen Bear Stearns, we'd seen Lehman's go, and it's basically the banking sector started one by one, or not one by one, it was probably more than that at some point in time, but removing traders and removing people from sales and trading roles. And I'd seen a few of my colleagues who hadn't made any money being shown the door in midway through 2008. And by the end of 2008, even the short vol traders at Goldman's who hadn't lost a cent. And when you think about the volatility which we were seeing in those markets, it was absolutely incredible. Those guys should have been given a medal. They didn't lose a cent, but by Christmas, those guys were leaving the firm. And by the start of 2009, I was back on, I was starting a new trading year, and it was going well, but this whole recession that started back then in the banking industry was still ongoing. And I remember the day that I walked into the office at Goldman's. It was March the 5th, 2009. And why I remember that was because the S&P had just printed its all-time low during that, not its all-time low, but had put its low print in for that GFC crisis period. And anyone that looks at the charts would know that the low for the S&P that day was 666, which, well, that's the devil's number. Now, I'm not going into, making any sort of connotations or anything like that, but for that reason, it stuck in my head. Anyway, next day I walked in. Tone, do you mind coming into the office? I knew what was going to happen. Things were pretty bad, but I'd seen my colleagues go, and that was the end of my trading days at Goldman. So I moved on from there and pushed into the sales role and kept a lot of my contacts which I developed there, and still talk to them today. And very grateful for that time I had there.
Wow, that's pretty fascinating. I love the story. It's pretty cool though. It's pretty like
Yeah.
it seems like a long journey and like a lot of adventure, but I like it. It's good.
Yeah, it was a fantastic adventure. I look back at it, and Eddie, and one of the things people are doing now that I'm doing what I'm doing is people reach out and say, well, look, this is, there's people in finance, young people that I've met and crossed paths with. They're saying, well, where do you think I should be going? What should my focus be? And it's a tough one because I can see the way the industry's changed over the last, even just the last 5 years. The way it's changed, it's going to continue to change. And they're saying, well, should I still be in finance? And I think I think finance is still a great spot to be. It's still a wonderful spot to learn. And they're saying, but am I better off going to engineering? And I don't know anything about engineering, but all I know is finance has changed a lot compared to when I started, and it will continue to change.
Hmm. You mentioned a couple of great things in the story, and one of them is the fact that you had to kind of work on the strategies a little bit. Sometimes you have to like reevaluate, change things a little bit. And you mentioned about trading like different markets, so trading commodities or this and that. How do you decide kind of what to trade? Is there like a rule or a process to go
Um,
through?
for me now, it's become ingrained that it's FX. And when I mentioned earlier, what I like about FX is all of these markets are correlated. Let's be honest, they're all correlated to some point of time. But the one good thing about FX is you've got a lead from other markets. So in many ways, FX is the second derivative of what is happening in other markets. So the lag isn't as great as it used to be, not with the way that high frequency and AI and big data firms are now interacting with markets. But for instance, I can still look at a chart and see a breakdown in the chart and go, well, what's the backdrop of what's happening there? Is there a good backdrop to support this chart? And I mentioned Aussie CAD earlier, and Aussie CAD's been a really good trade for the last week and a half. I don't know if you sort of, I think, and this also wraps into a bigger thematic, which I think is happening as well. But this coming into the start of June, we had, I think, one central bank talking about hiking. That was the Fed. By June 12, the deputy governor of the Bank of Canada, Carolyn Wilkins, started talking about tightening. The governor the next day backed it up. Pollers, he backed it up. Not long after, we then had the Bank of England. We had Carney, I guess, voted down and backflipped on his view that rates had to stay lower for longer. And then we also had Draghi come out from the ECB and talk about how rates, the end of QE there, and how there's the economy's doing very well. So all of a sudden we had a fundamental backdrop where we've been in this era of very, very low interest rates, even negative interest rates now for a very, very long time, probably close to 5-6 years, and it's coming to an end. And that's wonderful news for people like me with a macro technical slant, because we can look and all of a sudden, when I mention things drive FX, we're talking about interest rates. All of a sudden, we're looking to see whether the Bank of Canada can raise interest rates when it meets next week. I think it probably does. I think it probably takes away those emergency cuts which we saw when oil dropped. So all of a sudden, we're moving away from a world of zero interest rates. We're starting to see some divergence in what's happening in economies. You had the RBA come out this week. People thought there was a chance they'd be a little bit more hawkish, toe the line, if you like, that the other central bankers who are talking about tightening and financial stability, they would join that hymn sheet, if you like, and they didn't. So all of a sudden, you've got a very firm backdrop of an Australian economy where iron ore prices have come up the boil. Yes, employment's doing better, but then you've got the a very similar economy, if you like, in Canada, where they're telling you they're going to hike rates. So you've got this relative value trade coming into play there. You've got a big break on the charts, which was through that 99.30, 99.20 area. You've got what I would call a very strong marriage of fundamentals and technicals. So that's, I think, a big thing. But the bigger picture, I think, for me is that we are moving away from this era of very low interest rates, of negative rates, and whether it's because of financial stability, which I think central bankers are now concerned about, and let's not beat around the bush. They all do talk to each other. They're worried that they've created a bubble. They've taken their eye off inflation, which was their previous concern. For traders that need volatility, this is a huge thing, and it'll flow through into equity markets. I mean, when you look at the equity market, we talk about the S&P being back at 666 on March the 5th, 2009. Well, today it's sitting at 2,410. I mean, the increase has been absolutely, monstrous. So there's a very, very fundamental shift, or a regime change, I think, in the air, and this is all happening at a very, very interesting time, I think, for guys like ourselves that want to trade the markets, that want things to drive the market. It's a great thing.
Mm-hmm. And what would be your advice for people who don't really use fundamentals to trade, and they kind of want to be aware of all these things in the fundamental world? What would they like? Is there something they can look at or follow, or?
Yeah, I mean, the macro backdrop, the fundamental backdrop is it takes a lot of learning. I was lucky, and I think that's why technicals are such a great place to start, because any technical analysis is very subjective. That's probably the biggest criticism of technical analysis. There's also a lot of technical people out there saying it could be this, it could be that, and then when it goes the other way, they say, well, yeah, I told you it could be that. And I sort of think, well, you can't give a coin toss. It could be this, it could be that. You've actually got to put your reputation on the line and call where you think the market's going. Don't give me a could be this, it could be that. But coming back to technical analysis, the view there is, and I agree with this, is that a lot of information is already contained in the charts. So when you see Aussie CAD starting to drop, you see the pattern, you can see the break. A lot of that fundamental information is baked into the cake, if you like. For me, it's confirmation. But for someone that doesn't have access to that sort of information, it is confirmation for what I'm seeing in the charts. And this, I guess, comes back to another point where the big buzzwords in markets over the last 12 months have been basically high frequency, quants, programmers, big data, and all that type of stuff. And the funny thing is, I'm reading now from asset allocators saying they're moving money away from those high frequency and those quant firms. And the reason they're doing that is because there's not enough juice left in the markets for these guys. You've had a massive explosion in that field whereby, probably the original pioneer was Renaissance with James Simons at the helm. But now there's hundreds and hundreds of firms all trying to do the same thing. And as we know with markets, when they become crowded, when they become one way, when you lose that edge, you don't make money. So all of a sudden, investors are starting to move away from that type of thing, which 6 to 12 months ago was absolutely huge. So I think you're going to start to see people go back to some of the stuff which has worked, and technical analysis is something which has always worked. It always has worked. It always will work. How you put the pieces of your technical analysis together is up to you, but looking at charts, looking at patterns is what a lot of these guys are doing. They're just programming it. And I started trying to do some programming stuff back in the early 2000s. And I found that what I was actually programming was what I had trained my eye to see. So to me, it seemed like an unnecessary step. And I'm glad I've stayed on this path because to me, it still works and it is working. So I think if you don't have access to that macro information, if you're not a programmer, look at the charts, look at what the markets are doing, uptrends, downtrends. It's so true. I mean, people talk to you about the trend is your friend. It's so true. I mean, find a good trend, find a pullback, and try and set your trades in those pullbacks. Euro Aussie's been a terrific one, which I've spoken to my members about as well. The trend has been very, very strong. Started from 137, it ran up to 153. It went 16 big figures. That's a massive trend, huge trend. It's pulled back now recently back to around 147-ish. We got back on that trade. That's the type of trading which I think makes sense. And you don't need a programming degree or big data to work that out. You can look at a chart and go, that's a very strong trend. What do I want to be doing with this trend? I want to buy a pullback, and that's what we're doing.
Mm-hmm. And how much emphasis do you put on indicators when you trade? Do you have some things you'd like to look at?
There is. I like to look at RSIs for divergence mainly, particularly as I'm an Elliott wave guy. So I look for divergence a lot when I think there's a fifth wave potentially coming through. So if we get a new high in price, but the RSI hasn't confirmed that to me is a bit of a warning sign. I love candlesticks because the old trader in me from the futures floor day, those days where you used to see big moves and people shouting and climbing all over the top of each other. I see that in the candles. So I like what the candlestick charts visually represent, those big blue or those big green candles or whatever charting package you're using. To me, that makes sense. I look at stochastics. I think they give you a good read on where the market's going and where the market's been, but I wouldn't rely on indicators by themselves. I like indicators and I like candlesticks and I like Elliott wave all put together. Mm-hmm. And how you put that together, I think, is the trick.
And that's the part. Is you have to look for the right zone and the right level to base your trade, for sure.
That's right.
It's not only one. I like that. And the other thing you mentioned, which I was curious about, is you mentioned a year where you made 25% that year. And I know for a lot of people that would be something kind of inadequate because people get into trading with like high expectation that they want to become rich like quickly. So how do you, and I guess telling someone that they only have to make 25% per year is like really like putting the pressure down, which I think is good. what do you think
Yeah,
this is like acceptable, or what would you want people to aim for?
Eddie, and it's a really good question. And since I've turned my focus to this venture, it's opened my eyes a lot because people have got to remember the risk-free rate of return, as we have chatted about, is what your money in the bank's earning. And your money in the bank is earning, I don't know, a term deposit might get you 2.5% if you're lucky at the moment. Yeah. There's other areas where you can probably other countries where you can get a little bit more, but in Australia, 2.5% is your risk-free rate of return effectively. Um, the more you, the further you ratchet away from that risk-free return, the more risk that's involved. And I'm reading a lot of websites. I've joined some Facebook groups, and basically my premise to anyone is if it looks too good to be true, it probably is. And that risk-free rate of return has to be your benchmark. So if you see someone posting about binary options with a picture of a Lamborghini or an Aston Martin in it, it's absolute bollocks. So just stay the heck away from it. Use your common sense. So for me, what I suggest to people, 25%. When I look at the hedge, I still look at hedge fund returns and how the world's going at the moment in that institutional space. And I can tell you some of the big hedge funds of the world are down a lot, and we're 6 months into the year. So I'm not going to name names or anything like that, but if you do a hedge fund search, you'll see what those funds are. And it's just been it's been for them, I think, an unveiling because they went into the start of the year very confident of what Trump was going to do. They had very confident the US dollar was going to be higher, and they're very, very confident the bonds were going to be lower. And none of those big thematical themes have worked out, unfortunately, and that's another beauty of technical analysis. I have a view, but I don't get married to it. If a market breaks a level, I move to the sidelines. I reevaluate and I give it some time to settle down. A few people say, well, you should stop and reverse. That's not the way to do it for me. For my personality type, I'm not saying it's not the right way for other people to do it, but for me, I need to sit on the sidelines, take some time out, and have a look what's going on. So when we come back to returns at the moment, your top hedge funds globally are probably up around 10% at the moment. If they finish the year up 20%, they would be very, very happy. So I think people need to remember that these guys are professional investors. They're sitting there with the best Bloomberg software. They've got the best bank research. They've got staff to help them. They've got brokers to call them, and they're aiming for 20%. If you're a private investor and you're aiming for any more than 20%, it probably means you're taking too much risk on each trade. Personally, for me, 1% is about right in terms of the maximum amount I'll risk on a trade. So 1% of your capital, um, which if you're right and you're doing a 3-to-1 trade, it means you'll make 3%. The problem there is how often are you going to make 3% on a trade in these types of markets because they have been so choppy. So I think if you can make a couple of percent a month, you're doing really, really well in these markets.
And I know also a lot of people look for what we would call high probability trades, like the trades that the trading strategy would win like 9 times out of 10. I'm curious to know what would be your win rate on average, let's say.
Yeah, it's a good question, and I'm trying to. I will look at trades basis my level of conviction to a thematic, to a chart pattern, and to a macro. So in terms of that Aussie CAD trade, which I mentioned, it was very high conviction. So we went 2 times our usual capital or trade size allocation. Euro Aussie, 2/3 of your usual capital allocation because you're starting to get Aussie shorts on Aussie shorts there. I also like the look of Aussie Kiwi lower at the moment, but that's another Aussie short. So there's only so many Aussie shorts you can have on before something goes wrong. So you need to be mindful of that. Um, so to me, it's finding high probability setups and what my trading accuracy is. I'm not systematic, but I think my charting and my macro backdrop probably means I'm right close to 65 to 70% of my trades, whereby if I'm risking 50 pips on a trade, 70% of my trades will get 50 pips in the money. And this happened to me a lot when I started trading again at the start of the year. And it's a different mentality when you're trading your own money because you've got to put some money in your pocket at the end of each day because This is a job. We've got bills to pay. So I was finding that I was getting in the money on a lot of trades, but thinking this trade's got 100 pips in it. It's got 150 pips. I'm going to try and be true to my risk reward ratio. What actually happened when a lot of these trades was they snapped back, and they hadn't gone far enough for me to move my stop loss up. So I ended up losing money on profitable trades. So it took a few months for me to suddenly, I guess, scratch off the hey, I'm back trading again thing. And then it took another few months for me to work out if I get in a good trade, I've got to put some money in the bank. Um, so I think probably as high as 70%, but I'm not going for those 3-to-1 trades anymore. And I look at a coin toss, and if you can flip a coin and you know it's going to come up heads 70% of the time, and you're risking 1-to-1, well, you do that. You take that trade. So that's what I will allocate capital based on the conviction levels of these trades. A high conviction trade will obviously have more capital, a bigger face value than a low conviction trade. So I like to frame it in my strategic trades. My strategic trades are the ones which I call my high conviction trades. And then I try and provide a bit of tactical type trading as well, which is probably more your day trading type stuff. And I would liken my day trading tactical type trades as to what a spot trader might do on a desk sitting opposite me when I was in a sales role. So, they're looking to buy the support on a 60-minute or a 4-hour time frame, and they're trying to job it out, 30, 40 pips higher. So, but for me, the where I see my edge and where I put the higher conviction trades is more on those strategic longer term trades. And by longer term trades, I'm talking about 2 to 5 days as opposed to 1 day to 2 day type trades.
Makes sense. And yeah, makes sense. But what I want people to understand is that you have a lot of experience and you've seen exactly like what is a good trade and a bad trade. Like what is a trade with high conviction, because that takes a lot of practice to see. So people cannot just jump in and like from tomorrow decide that they want this is a good conviction or not. So
Yeah, well, that's the problem. I mean, in theory, every trade you take should be given the same amount of capital. That's the theoretical part of it. But if you've got a strong feeling where there's a macro and a technical backdrop all lining up, that's when I will. And as I said, I'll wait for the data to confirm what I'm talking about. So I took a short Aussie CAD into the RBA. I had a level in mind that if it broke 99.20, I would add to that trade, which it did. We added to the trade. So I am able to add to trades. What I'm trying to do is to pyramid into trades which are going in the right direction for me, where I know that I'm not risking that much more of my capital. So, I thought, well, this thing's broken down below 99.20. I can probably have a stop now 30, 40 pips away. Let's add to it. It doesn't significantly increase our risk by too much if we're wrong. That's what I'm talking about in terms of actually adding and pyramiding into trades. I go back to a time at Goldman's, and the funny thing about Goldman's trading years were we always started December 1 because they were on a funny calendar. And as you know, with markets, probably the worst time to be trading it's probably around August because that's the Northern Hemisphere summer. If you've worked I've worked at BNP and I could send an email in the middle of June and it wouldn't get answered until the end of August because the Europeans take their vacation time during those months, and the French like a holiday. But so no offense to any French people, but it's a great way of life they've got, and it's a great work-life balance. I respect that. But for Goldman, they'd start their new year December 1, and it's also a shocking time of the year, that sort of 2 weeks before Christmas and the first 2 weeks after Christmas are very, very difficult because people go on holidays, the liquidity dries up. But with the type of trading we were doing, there was a real emphasis on getting some money in the bank, get some profitable trades in the tin, get some money in the bank for the new year, and then you can start to trade a little bit bigger. Unfortunately, it was the wrong time of the year to be doing that. And a couple of times I found myself, I'd had 5 or 6 losing trades in a row to start the financial year. And I remember thinking, and my manager looked at me, and I'd come in one day and I'd had another losing day, and I knew what he was thinking because these guys, they're traders as well. The managers of trading rooms are trading the traders, so they're looking and thinking, well, hang on, this guy's just dropped 3 or 4%. make no mistake, these hedge funds, these prop rooms, they don't like you losing. When we talk about how much money you can lose, a lot of these hedge funds today, you lose 7%, 8%, you're out the door, you're looking for a new job. So if you think, well, I'm going to risk 2% on 4 trades and you have 4 losing trades in a row, you're out the door. So you've got to build a bank slowly. And that way, it's basically the emphasis is on you to build that bank and to build your trades. So I know I can have 6 or 7 losing trades in a row, but as I started trading, as I got more experienced, I'd realized if I had 3 losing days in a row, there was a good chance I was going to have 5 or 6. So I'd put myself in the sin bin. I'd give myself a yellow card. I'd get out of the trading room and I wouldn't look at markets for 2 days. And then I'd come back in with a fresh set of eyes and I'd start again. So in effect, I gave myself a circuit breaker. So I think that's one of the things traders need to remember. If you're on a losing run, you need to short circuit that losing run. You need to don't go chasing money you've left or you've donated to the market. You need to walk away, come back with a fresh set of eyes, and start again.
That's really, really powerful. And I want to respect your time. We're already like almost an hour in the interview, but is there anything you do like that is unique to you whenever you trade that other traders don't necessarily do?
Yeah, look, I go back to my time at the trading room, and one of my buddies, when I was first trying to work out how to make the sort of money which made us relevant, and arguably we did that or we didn't, doesn't matter. We were sort of trying to become relevant there and turn the needle. And chatting to a buddy, he said, "Well, look at what the best guy in the room's doing and follow him." And it's not rocket science, right? I mean, you need to have mentors. You need to have people showing you what to do. And the funny thing with this type of trading is I could know what the senior guys in the trade, we're all fairly open. We all chatted about markets, what the senior guys in the room had on position wise at 3:30 when they went home, because they had to trade at night. So we were probably only in the office between 10 and 4 o'clock most days. I could know what the senior guys had in the markets, but by 4:01, their positions could have flipped entirely. So what I would say is, traders have to stand on their own feet. You have to make your own decisions. You have to find a methodology that works for you. And for me, I've found my happy space, if you like, in terms of how I feel I can generate an income from trading. And that to me is the mixture which I've spoken about. It's unique to me. I love my charts. I look at charts in 2 different ways. I look at them in a technical sense. I look at what's, as I mentioned to you, what's below the chart, what's driving the charts, what's happening to rate spreads, what's happening to terms of trades, what's happening to equity markets. I put that together, and that's, I guess, my trading style.
I like that. Awesome. How can people find you if they want to connect with you or reach out after the interview?
Absolutely, yeah. So the best way to find me is my website, which is www.techfxtraders.com, which is all one word. You can, a lot of the stuff which we've chatted about probably is touched on that website, but yeah, I'd love you to come by and check me out. And yeah, I'm on Twitter, I'm on Facebook, so TechFX Traders up and running.
Cool. So we'll make sure to put all the links in the show notes over at thisartstrade.com. If people want to connect with you, they're going to find all the links there. What kind of goals do you have for the future?
Goals for the future. Well, my goals for the future, I think this is a job which I'm mid 40s now. I think I can. I've wanted to stay. I've been wanting to be in the markets my whole life. I want to stay in the markets, but as I mentioned, I've got children, and the last 7 years I haven't seen a whole lot of them. You're doing 60 hours a week on a retail, on an FX desk. You get home at 7 o'clock at night. Your kids go to bed at 8 o'clock. You see them for 5 hours a day during the week. When you go to work, they're still asleep. So, for me, where I want to be is I want to be trading. I want to be helping people, and I want to see. My family's a huge part of my life, and I want to be able to put all those things together, and that's, I think, something I can do in this role for another 10, 15 years.
Awesome. Love it, love it. And we have a question we ask the guests at the end of every podcast. If you could give only one piece of advice for traders in one sentence, what would that one sentence of advice be?
Yeah, okay, you kind of caught me on the hop there, but there's one very strong piece of advice I was given when I was back trading, and that's, if you look after your downside, your upside will look after itself. And that's referring to risk management, and it's talking about discipline, and everyone needs it. And that's the one bit of advice which I think's, 10 years later, I still remember it as clear as day.
Love it, love it. Tony Sycamore, thanks so much for being on the podcast. It's been a pleasure to have you here.
Pleasure to be on the show, Eddie, and thank you very much.
Thanks for listening to the Desire to Trade podcast. To get all the information on this show, free articles, and unique resources, make sure to check out www.desiretotrade.com and subscribe. Please leave us a review and let us know what you thought about the show. It's time to become the best trader you can be. See you next time.